All right, guys, today we are back with another book review. All right, so the reason I'm doing these is so that I can make your trading journey easy. I can make it swift, and I can make your trading journey educated. So use me for your cliff notes. I'm doing this because I'm reading the books. I'm gonna already do the research anyways, and this is my book report on the book. So in a way, I'm also able to show myself approved and to provide you with an opportunity and a resource to get all the gems and the information from the book without having to read the book and just skip right through it. So even if you watch these and you just play them on, 2 times the talking speed, you understand, you can ride along in your car, listen to them, and you get a lot of value out of it. So today's book, let's go ahead and get on into it, is Charting Made Easy by John J. Murphy. All right, let's see here. Got a couple, contents. Why is chart analysis important? What is it? How to plot the daily chart, support and resistance trend lines, reversal and continuation patterns, price gaps, key reversals, percentage retracements, interpretation of volume, using different time frames, using a top-down market approach, moving averages, oscillators, ratios and relative strengths, options, the principle of confirmation, summary and conclusion. All right, so chart analysis is more popular than ever due to the availability of highly sophisticated, inexpensive charting software, i.e. the internet. Another revolutionary development for traders is the availability of live market data. During the second half of 1999, technology was the place to be, and that was reflected in the enormous gains in the NASDAQ market. Biotech and high-tech stocks were the clear market leaders. If you're in those groups, you did great. Having access to charts and data is especially helpful if the trader knows what to do with them, and that's the purpose of this book. Hold on, give me one moment. There we go. All right, so whether the market participant is a short-term trader or a long-term investor, price forecasting is usually the first most important step in the decision-making process. There are two methods of forecasting available: market analysis, there are two methods of forecasting available to the market analyst: the fundamental and the technical. Fundamentals based on traditional study of supply and demand factors that cause market prices to rise or fall. Look at corporate earnings, trade deficits, changes in the money supply. The intention of that approach is to arrive at an estimate of the intrinsic value. Then there's the technical or chart analysis, which is by contrast based on the study of the market action itself. While fundamental analysis studies the reasons or causes for prices going up or down, technical analysis studies the effect of the price movement itself. Chart analysis is extremely useful in the price forecasting process. Price forecasting, however, is only the first step. The second, and often the more difficult, is market timing. Precise entry and exit points is an indispensable aspect of any market commitment. To put it bluntly, timing is everything in the stock market. We have chart analysis, also called technical analysis. It's the cornerstone of the technical philosophy is the belief that all the factors that influence market price, fundamental information, political events, natural disasters, and psychological factors are quickly discounted in market activity. In other words, the impact of these factors will show up in the chart in some form of price movement, either up or down. Chart analysis is therefore a shortcut form of fundamental analysis. Yep. Charts reveal price trends. The market moves in trends, and that is revealed through the charts. Most techniques are used for the purpose of identifying significant trends to determine the extent of those trends. The most popular chart is the daily bar chart, the Candlestick charts are also used in the same way as daily bar charts, but a more visual representation. Line charts can also be employed. Time dimension. Charts can be employed for any time dimension. That is to say, months, years, weeks, days, hours, minutes. How to plot the daily bar chart. Charts are used primarily to monitor trends. Two basic premises of chart analysis are that markets trend and that trends tend to persist. An uptrend is a series of rising peaks and troughs. A downtrend shows descending peaks and troughs. There are three types of trends, three categories: major, secondary, and minor. A major trend lasts more than a year, a secondary trend from 1 to 3 months, and a minor trend usually a couple of weeks or less. Previous trough usually forms a support level. Support is a level below the market. Resistance is marked by a previous market peak. Resistance is a level above the market where selling pressure exceeds buying pressure. Support and resistance levels reverse roles once they are decisively broken. While it takes 2 points to draw a trend line, a third point is necessary to identify the line as a valid trend line. If prices in an uptrend dip back down to the trend line a third time and bounce off of it, a valid uptrend line is confirmed. You have two major uses that allow identification of support and resistance levels that can be used while the market is trending. As a rule, the longer a trend line has been in effect, the more times it has been tested, the more significant it becomes. Reversal and continuation price patterns. Head and shoulders is the best known and probably the most reliable of the reversal patterns. Continuation patterns take less time to form than reversal patterns and usually result in resumption of the original trend. So we have a head and shoulders, which has a head. There's a neckline, which is the trend line drawn between two intervening reaction lows. There's the double and triple tops and bottoms. Triple tops or bottoms and the head and shoulders reversal pattern are interpreted in similar fashion and mean essentially the same thing. Let's see here. Saucers and spikes, two patterns. These two patterns aren't as common but are seen enough to warrant discussion. The spike produces a sudden change in trend. The saucer, by contrast, reveals an unusually slow shift in trend. There are continuation patterns, triangles. The symmetrical triangle, also called the coil, is distinguished by sideways activity with prices fluctuating between two converging trend lines. The upper line is declining and the lower line is rising. Such a pattern describes a situation where buying and selling pressure are in balance. There's the ascending triangle, descending triangle, flags and pennants. Pennant is usually horizontal with two converging trend lines, like small symmetrical triangle. The flag resembles a parallelogram that tends to slope against the trend. These patterns occur often near the middle of the trend, marking the halfway point in the market move. Okay. Gaps are simply areas on the bar chart where no trading has taken place. An upward gap occurs when the lowest price for one day is higher than the highest price of the preceding day. A downward gap means that the highest price for one day is lower than the lowest price of the preceding day. Different types of gaps appear at different stages of the trend. Being able to distinguish between them can provide useful and profitable market insights. 3 types of gaps have forecasting value: breakaway, runaway, and exhaustion. Let's see. Breakaway gap usually occurs upon completion of an important price pattern and signals a significant market move. The runaway gap usually occurs after the trend is well underway. It often appears about halfway through the move, which is why it is also called a measuring gap, since it gives some indication of how much more of the move is left. During uptrends, breakaway and runaway gaps usually provide support below the market on subsequent market dips, and vice versa on the downtrend. It acts as resistance over the market on bounces. The exhaustion gap occurs right at the end of the market move and represents the last gasp in the trend. There's also the island reversal. The key reversal day is a minor pattern which warns of impending change in trend. The wider the day's range and the heavier the volume, the more significant the warning becomes and the more authority it carries. Percentage retracements. Markets trends seldom take place in straight lines. A minimum retracement is usually about a third of the prior trend. The 2/3 point is considered the maximum retracement that is allowed if the prior trend is going to resume. Chartists also place importance on retracements of 38% and 62%, which are called Fibonacci retracements. There's volume interpretation, and it provides important secondary confirmation of the price action on the chart and often gives advance warning of an impending shift in trend. As a rule, heavier volume should be present in the direction of the prevailing price trend. During an uptrend, heavier volume should be seen during rallies, with lighter volume during downside corrections. In downtrends, the heavier volume should occur on price sell-offs. Bear market bounces should take place on a lighter volume. Volume is an important part of price patterns. Each day that a market closes higher, that day's volume is added to the previous total. The OBV line is usually plotted along the bottom of the price chart. If prices are rising but the OBV line is flat or falling, that means there may not be enough volume to support higher prices. In this case, the divergence between a rising price line and a flat or falling OBV line is a negative warning. The OBV line will sometimes break out first and give an early hint of future price direction. An upside breakout in the OBV line should catch the trader's eye and cause him or her to take a closer look at the market or stock in question. Other volume indicators include the accumulation distribution, Chaikin oscillator, market facilitation index, and money flow. Using different time frames for short and long-term views. It's not limited to daily bar charts. Weekly and monthly charts provide valuable long-term perspective on market history. Weekly charts show almost 5 years of data, while the monthly charts go back over 20 years. Using intraday charts are useful for immediate and long-term analysis. Intraday charts are extremely valuable, such as the 15-minute bar chart, 1-minute chart, 5-minute chart. Going from the long-term to short-term, and as indispensable as the daily bar charts are to market timing and analysis, a thorough chart analysis should begin with the monthly and weekly charts, and in that order. Only then should the daily chart be studied. Excuse me, I'm doing a lot of talking today, apparently. Chapter 11, using a top-down market approach. Begins with a broader view, and gradually narrowing one's focus has another important application. This approach utilizes a three-step approach to finding winning stocks. It starts with an overall market view to determine whether the stock market is moving up or down, and whether this is a good time to be investing in the market. It then breaks the stock market down into market sectors and industry groups to determine which parts of the stock market look the strongest. Finally, it seeks out leading stocks in those leading sectors and groups. That's very key. Top-down analysis. First, determine the trend. Talks about the different composites in Dow Jones, New York Stock Exchange, the S&P 500, NASDAQ, the Russell 2000 indexes, and what they measure. Second step, sectors and industry groups. There are 10 market sectors, which include basic materials, consumer cyclicals, consumer non-cyclicals, energy, financial, healthcare, industrial technology, telecommunications, and utilities. Each of these sectors can have as many as a dozen or more industry groups. For example, technology sector has the computers, internet, networkers, office equipment, and semiconductors. Financial sector includes banks, insurance, and securities brokers. Third step, individual stocks. For those investors who deal in individual stocks, this is the third step in the top-down market approach. Having isolated an industry group that has strong upside potential, the trader can then look within that group for winning stocks. It's been estimated that as much as 50% of a stock's direction is determined by the direction of its industry group. If you've already found a winning group, your work is half done. Another advantage of limiting your stock search to winning sectors and groups is that it narrows the search considerably. There's moving averages are extremely popular with market technicians, and with good reason. Moving averages smooth the price action and make it easier to spot the underlying trend. The most popular moving averages are 50 days and 200 days. During an uptrend, prices should stay above the 50-day average. Minor pullbacks often bounce off that average, which acts as a support level. A decisive close beneath the 50-day average is usually one of the first signs that a stock is entering a more severe correction. In many cases, the breaking of the 50-day average signals a further decline down to the 200-day average. If a market is in a normal bull market correction, it should find new support around its 200-day average. For short-term trading purposes, traders will employ a 20-day average to spot short-term trend changes. Bollinger Bands are plotted Bollinger Bands are trading bands that are plotted 2 standard deviations above and below a 20-day moving average. When a market touches or exceeds one of the trading bands, the market is considered to be overextended. Prices will often pull back to the moving average line. Moving average convergence divergence, MACD, is a popular trading system. Oscillators are used to identify overbought and oversold market conditions. Oscillator helps to measure market extremes and tells the chartist when a market advance or decline has become overextended. RSI, Relative Strength Index, is one of the most popular oscillators. It's plotted from 0 to 100 with horizontal lines drawn at the 70 and 30 levels. A reading above 70 is considered to be overbought. A reading below 30 is considered to be oversold. Stochastics is another oscillator plotted on a scale from 0 to 100. Oscillators can be employed in any time dimension. There's the ratios and relative strengths, which technical analysis can be applied in ratio charts. Then there's options. The main advantage of trading options is limited risk. The option trader pays a premium. The principles of market analysis are not applied to the option itself, but to the underlying market. Talks about the option put call ratio as applied to the S&P 100, the OEX, the contrary indicator, CBOE volatility index, VIX is a contrary indicator based on the volatility of the S&P 100. The principle of confirmation holds that more than one technical evidence supporting a given analysis, the stronger the conclusion becomes. Summary and conclusion. Market timing. And there's investing tools for resources, successes and resources. All right, guys. So we made it to the end of the book. If you stuck around to the end of the book review, I think this is a great book to get started. If you don't know how to read a chart, if you're trying to figure out how to get started with charts and what support means and what resistance means. When I first read this book, I actually made flashcards about the book so I could understand the different tools, the language, the lingo, so I could understand like what people were talking about when they were talking about OEM or VIX or support and resistance or trend lines or the different patterns. So this is a very great book that it has a lot of the information that you need very immediately when you very first start trading, just to be a part of the conversation that people are having around. Oh, did you see that head and shoulders pattern? Or did you see that triple bottom pattern? Or these different patterns, which as you get more into trading, you'll see that patterns are another indication of where the market is moving, as well as where to buy and sell when you are making your trades. So again, I'm glad you guys stuck around to the end. Use me as your Cliff Notes. If you want me to review a different book, or if you like the way I reviewed this book, drop some comments in the comment section below. This has been Charting Made Easy by John J. Murphy, and I will see you guys on the next one. Farewell.